This first week of March was not a very good week as far as stock market is concerned. Some of the big stocks which led this bull market in 2020 were in sort of free fall that led to the considerable destruction of wealth in the markets. As an example, Tesla stock, which had a huge run up last year, was down almost 33% from its peak of $900 to $597 a share on March 5 at the close of the market. Some people are projecting it as a doomsday, and others are finding buying opportunities in this dip. In this video, I will share my perspective why the market is going down and what I'm doing given the extreme dip in the stock market. Hi, my name is Sunny and welcome to my channel Sunnysnippets. Here, I try to make videos that affect a common man financially. If you're new to this channel, please smash that like button as that will help me with the YouTube algorithm and it will be highly appreciated. There are many reasons why the stock market is behaving the way it is behaving right now, and I will try to put forward my thoughts about it, about this rapid fall. The present day international monetary system was set up by Western allies led by the US after World War II when the victorious Western powers met in Bretton Woods in 1944. The establishment of IMF was one of the outcomes. Over the years, the US got established as a major economic superpower with its US dollar becoming the world's reserve currency. This reserve currency status, in a way, nudged the foreign governments to hold their currency reserves in the form of US governments, which did two things. Number one, that gave the US government a unique position where they can borrow at a very low interest rate. Number two, it can afford to run deficits year after year. Now, a couple of things are coming together. The reserve currency status of the US dollar, along with the high demand of US dollar debt, has allowed the government to borrow at historic low interest rates for a very long time. So, whenever there is a recession, governments around the world pumped money into the economy to give it a boost. The US did the same and much more because of the US dollar's reserve currency status. The Fed has the ability to lower interest rates. As a result, the US government can borrow at negligible cost and spend that money. This spending can be in the form of financing the wars or stimulus spending to prop up the economy. It is a matter of fact that US government has been running the show with deficit spending for a while now, meaning they're spending the money they don't have right now. Instead, they borrow it by issuing US government debt whose interest rates they control. But as we all know, eventually all the parties come to an end when the lender realizes that there is too much debt in the system. Recently, there is a feeling in the market that the Fed will start increasing the interest rates. The main logic is that with so much stimulus money being spent by the US government to prop up the economy during COVID 19 slowdown, with all that increase in money supply, eventually the inflation will come. The mandate of the Fed is to maintain a stable inflation in the economy, so the worry is that eventually the Fed has to start increasing the interest rates. Right now, the US interest rates are at almost 0%, which is like a free money. The smart minds in theory are able to borrow at historic low interest rates, which is almost 0%, then put that money to use by buying assets like stocks or real estate. When so much cheap money is chasing those assets, we have asset bubbles. This brought in the fear of increase in interest rates, leading to slowdown in purchase of these assets. On the flip side, people get nervous, so rather than buying, they are in some cases selling. That puts the downward pressure on the prices of these assets, including stocks. In the market, there are broadly two types of assets. Bonds and stocks. Let's talk about bonds first. Bonds are basically loans which companies or governments issue at fixed interest rates at the time of issue to be redeemed at a future date. These bonds are often traded on stock exchanges and are very sensitive to present interest rates. Now, if the interest rate increases, the price of this already existing bonds generally fall, because why would any investor now buy a bond which was issued at a lower interest rate? Thus, to compensate that, the investor wants a discount on the price of the bond. Hence, the price of the bond falls. When the price of the bond falls, but since it was issued at a lower interest rate, the return on that bond called yield increases. On the flip side, if the interest rate reduces, the price of the existing bond usually increases, meaning the investor can get more interest rate from the bond as compared to the present rate, which has reduced now. Thus, they are willing to pay a premium for the bond as the price of the bond increases, but since it was issued at a higher interest rate, the return on that bond called yield decreases now. Bonds are considered relatively safer investments as mostly people use it for wealth preservation. Now let's look at stocks. Unlike bonds, stocks are a reflection of the future earning power of the company, thus, they are not issued at a fixed rate like bonds. This inherently makes stocks more volatile than bonds, and people use stocks for wealth creation. Now, in the scenario when interest rates might be going up, there is often a flight of capital from stocks to bonds, and bonds look more attractive and stable than stocks, thereby putting more downward pressure on the stock prices. Stimulus is nothing but a form of money injection into the economy, which the governments all over the world do to kickstart or accelerate the rate of economy. Since the US dollar is the reserve currency of the world, so the US government is in a very unique position where they can borrow trillions of dollars at ultra low interest rates to stimulate the economy. It is nothing but money printing, thus increasing the money supply in the system, thereby propping up the economy. Eventually, with all that money printing going on, the inflation will start to increase and the Fed has to increase interest rates. This is another reason why the stock markets are fearing that interest rates might be going up in future. The Fed chair has said that he doesn't see the interest rates going up anytime soon. We know the markets often move based on human sentiments. They never go in straight line, but like pendulum, they move from one extreme to another. You will find them very optimistic one day, and the next day there is gloom and doom. There are two types of people who invest in the stock market. One, these are called traders. They ride the trend for short term, which can be going up or down. Number two, these are called investors who take long-term view of the company and look at the macro factors before investing. These are mostly not worried about day-to-day fluctuations as they take a multi-year view. As a matter of fact, I fall into the second category of investors where I invest with 8 to 10 years time horizon. A smart man once said, only invest that money in stock market that you don't need for the next 8 to 10 years. When I saw my high conviction stock on sale this week, I bought the dip as fundamentally nothing has changed for that company within this week. One of the stocks that I bought this week was Tesla. Let me spell out my reasons of buying, but before that, as a disclaimer, I'm not a financial advisor, but a common Joe on YouTube sharing his experiences with his audience. So don't forget to consult a financial advisor before investing based on your personal financial situation. This is the weekly chart for Tesla from March 1st to March 5th, 2021. As Tesla is my high conviction stock, So when I see its stock price dropping from about $750 to about $530 a share in a span of 5 days, there is one bell that rings in my head. It's a sale. This is the 1 day chart of Tesla on March 5, 2020, when you can see the stock going from 620 to almost $540 intraday. I personally find this as a buying opportunity. So, in this week, I added 47 more shares of Tesla to my portfolio at an average price of about $650. I know it might go down even further in short term, but I take a long term, multi year view of the company and the man behind it, Elon Musk. Personally, I'm a long term Tesla shareholder. I strongly believe that the party has just started for Tesla, and I will even buy more shares if the price goes down and take advantage of dollar cost averaging. This is my take, crashing stock market, and I'm buying. If you like the content that I make, please help me by liking, sharing, and subscribing to my channel. Thanks for watching. See you next time in the next video on your own channel, Sunny Snippets.